It's June 2026, and in this explainer, we're tracking a massive financial paradox. Palantir is trapped. The company is enduring its sharpest stock drawdown of the entire year, dropping from a high of $207.52 while simultaneously reporting the fastest revenue growth in its entire public history. It is a severe disconnect between raw operational execution and stock price action.
Our analytical framework, the fundamental disconnect, the valuation squeeze, market interpretation, reality checks for both the bulls and the bears, and finally, trading versus investing frames.
Part 1. What is actually happening? The fundamental disconnect.
The stock is currently stuck in a highly volatile consolidation phase, bouncing tightly between $112 and $156. That represents a roughly 26% year-to-date drop from the highs. The tension hinges on one specific mathematical contradiction. We're staring at a terrifying trailing price-to-sales ratio sitting at 61 times. Historically, that is a wildly unsustainable level for enterprise software. But it's colliding directly with staggering fundamental momentum, $1.63 billion in Q1 revenue.
And that total revenue figure, it represents an 85% year-over-year growth rate. This isn't a slight beat. 85% is the absolute highest reported revenue growth rate in Palantir's entire history as a public company. It entirely contradicts the bearish price action dominating the chart over the last several months.
Part 2. Why it's happening. The valuation squeeze.
The primary driver punishing the stock right now is severe valuation multiple compression. Hypergrowth is incredible, but it's no longer enough to support the stock if the entry multiple was already priced for absolute perfection. Institutional investors are weighing these astronomical price-to-earnings multiples against cold cash realities. With a trailing PE of 150 and a forward PE nearing 195 times, perfection is baked in. Compounding that concern is the mathematical reality that free cash flow yield sits at a mere 0.70%. Those are numbers that leave exactly zero margin for error in execution.
Part 3. Market interpretation. The Wall Street consensus shift.
In light of that Q1 data, institutions and analysts are rapidly repricing the future. We currently see a split consensus, though it heavily leans positive. 18 buys against 10 holds, alongside just one outperform, one underperform, and a single sell. The mean price target sits at $184, which implies roughly a 35% upside from the $136 support level. But look at the high target. Citigroup holds it at $260. Hitting that requires Palantir to flawlessly execute its AI platform rollout without a single quarter of deceleration.
Part 4. Bull case reality check. Execution at scale. Turning strictly to Palantir's internal Q1 2026 reporting metrics, the operational momentum is just aggressive. The numbers completely validate the institutional bull case that adoption of the artificial intelligence platform is accelerating. U.S. revenue is the undisputed engine here. Total U.S. revenue crossed $1.28 billion, up 104% year-over-year. Digging deeper into the commercial side, U.S. commercial revenue grew 133% year-over-year to $595 million. That segment drove 206 closed deals worth over $1 million each just in the first quarter alone.
The quality of that growth is undeniably validated by the Rule of 40 score, which hit a massive 145% in Q1. Remember, the Rule of 40 combines revenue growth rate with adjusted operating margin. A score of 145% mathematically proves the company is not trading growth for profitability. They are drastically accelerating both at the exact same time.
If you want bull versus bear stock analysis without hype, subscribe to Future Ready.
The balance sheet reinforces this execution. Palantir ended the quarter with $8.0 billion in cash, cash equivalents, and U.S. Treasuries, and they're carrying zero debt. They generated a massive $925 million in adjusted free cash flow, which represents a 57% margin. This is literally a fortress balance sheet funding its own expansion. Part 5. Bear case reality check. What can break the stock?
We must shift objectively to the systemic risks. Even with a fortress balance sheet, there are specific saturation points and hidden risks that bears are actively weaponizing against the stock right now. The bearish narrative really gained public traction when Michael Burry labeled the stock a sandcastle supported only by AI applications narrative. That critique ignited retail skepticism, and it demonstrates exactly how narrative deflation occurs when market capital costs remain high.
The structural risks here are highly specific. First, continued insider selling between $132 and $160 signals to markets that management views the stock as fully valued. Second, the UK Parliamentary Committee actually designating Palantir an unacceptable point of weakness creates serious headline risk for international government contracts. Finally, mechanical arithmetic dictates that Palantir must deliver 33.9% annual revenue growth for 7 straight years, hitting $40.3 billion in revenue at maturity, just to justify today's valuation multiple.
Part 6. Trading versus investing frames.
Because of the extreme tension between operations and valuation, approaching the stock requires bifurcating your strategy. The priorities for swing traders and long-term tech investors are fundamentally opposed right now. For the swing trader frame, the mandate is to completely ignore the long-term AI structural story, trade strict momentum conditions, and respect the technical support floor at $112. With a forward multiple near 195 times, the stock has immense risk sensitivity to multiple compression. The volatility zone up to 156 provides the strict technical boundaries.
The long-term investor frame requires focusing entirely on the structural durability of that U.S. commercial business. Earnings growth is the anchor here. Ticker's base case valuation models project an earnings per share compound annual growth rate of 53% all the way through 2035. This earnings trajectory makes Ticker's $985 target by December 2030 mathematically plausible, even while absorbing a built-in 8% annual PE compression.
If you want bull versus bear stock analysis without hype, subscribe to Future Ready.
Finally, Part 7. What matters next? Q2 catalysts to watch. Moving forward, the market requires specific triggers to decide whether this stock breaks out of its consolidation phase or faces further multiple compression. Palantir management significantly raised their full-year guidance to $7.65 billion in revenue, but the immediate catalyst is Q2. Management is targeting an adjusted operating income of between $1.063 and $1.067 billion.
The crucial metric that dictates Wall Street's next move is U.S. commercial revenue. Will it cross $700 million in Q2? Sustaining back-to-back quarters of 100% plus segment growth is the exact durability metric that historically forces the market into a massive consensus re-rating. That is the definitive signal to watch. The numbers don't lie, but the market's interpretation of them is about to be violently tested. Keep your eyes on the data.